If you want to master personal finance, you'll quickly find that experts sharply divide on one single tool: borrowed money. One camp demands you completely eradicate every cent you owe to achieve financial peace. This is the strategy built by radio host and author Dave Ramsey. The other camp preaches the exact opposite, encouraging strategic debt accumulation to maximize leverage and generate passive income. This strategy is championed by real estate investor and best-selling author Robert Kiyosaki. You must determine if debt is a trap that guarantees you stay broke or a mathematical tool required to build generational wealth. Before examining their differences, we have to look at the one crucial point both men actually agree on. Neither of them thinks you should borrow money to buy things that drop in value. Consumer debt, like credit card balances or personal loans, is universally bad. A luxury car is a depreciating liability. It drains cash out of your pocket every month, while the asset itself loses value. Their philosophies only violently diverge when deciding what to do with a home mortgage or capital meant for investing. Neither guru is mathematically wrong. The correct path depends on your behavioral discipline, your stomach for risk, and your willingness to manage assets. Dave Ramsey's framework treats personal finance as an 80% behavioral issue and only a 20% math issue. To make his system work, you must commit to his baby steps, cut up your credit cards, and live strictly below your means. In this framework, the paid-off home mortgage replaces the luxury car as the ultimate status symbol of choice. Following these rules creates a predictable outcome. Your balances hit zero, removing the psychological weight of monthly payments. However, eradicating all debt comes at a high opportunity cost. This chart shows the trade-off. Paying off a 3% mortgage early locks in a 3% return, while putting that same cash into the stock market historically offers a higher yield over time. The Ramsey approach purposefully sacrifices the maximum velocity of wealth in exchange for financial safety and survival. Robert Kiyosaki operates in a different reality. He advocates using other people's money to rapidly accelerate your net worth. He defines good debt as bank loans used specifically to buy an asset that generates enough cash flow to cover the payments and provide profit. A bank loan buys property, tenant rent pays the bank, and you keep the surplus. This leverage loop acquires massive assets with little starting capital. Real estate also unlocks significant tax deductions, lowering your taxable income to zero. Because of these mechanics, Kiyosaki deeply distrusts cash. He points to the 1971 removal of the gold standard as the moment the dollar began losing value to inflation. Instead of saving cash, Kiyosaki converts his earnings into tangible assets, like these gold bars, to preserve his wealth. Kiyosaki's method offers a path to rapid scale and tax-free income, but it requires treating every investment as a rigorous second career. Financial planners warn that both systems contain hidden, potentially catastrophic flaws if followed blindly to their logical extremes. For Dave Ramsey, the math breaks down in his retirement advice. He recommends that retirees can safely withdraw 8% of their savings every year. Critics argue this rate is high. Factor in inflation and market volatility, and retirees quickly exhaust their savings. Robert Kiyosaki faces the opposite flaw in extreme leverage. He has publicly admitted to carrying $1.2 billion in debt. Operating with that much debt leaves zero margin for error. A single economic crisis or vacancy spike could collapse the entire portfolio into bankruptcy instantly overnight. Extreme safety risks, running out of money slowly over time. Extreme leverage risks, losing everything in a single market crash. General financial advice is dangerous because it ignores your unique profile. You must stop asking who is smarter and start asking which system matches my behavior. Let's look at this decision tree. The first point involves evaluating your current financial discipline. If you have bad habits or credit card debt, follow Dave Ramsey. You need behavioral correction and emotional stability, not leverage. If you are already debt-free, move to the second node. Do you want to actively manage real estate and study tax law? If you are highly disciplined and willing to treat investing as an active business, follow Robert Kiyosaki. If you are disciplined but want to remain completely passive, you should seek a middle ground, such as traditional index fund investing. Adopting a financial system that conflicts with your natural personality type is the fastest way to fail at wealth building. There is one final warning. Do not attempt to mix these two profiles. Applying high-risk leverage tools while possessing only a beginner's financial literacy creates a scenario that leads directly to total, irreversible bankruptcy. You must master the baseline behavioral discipline of Ramsey first, before even considering graduating to the leverage of Kiyosaki. Debt functions as a tool whose safety depends entirely on the financial competence of the person wielding it.